Hello, everyone. Today on the final bar, my guest is Ari Wald from Oppenheimer. We're talking to Ari on a day when the S&P, continuing to chop around this 3,400 level, unable to break through it yet, but sort of at that point, we're right staring over the precipice. Do we continue the momentum upside? Do we further on this pro-growth story, moving the S&P to further highs, or is this a backing and filling pattern? Metals, especially gold, silver, reacting back to the upside after a couple weaker days earlier this week. What's next there as well? Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the final bar. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for the show as we make sense of the movements of the markets, try to get as good of a read as we can on the technical stories of the day, the themes, the patterns, following the momentum, following the trends as best as we can, and anticipating when those trends are shifting. As we've talked about in recent weeks, I feel like for a while is this concept of sector rotation, leadership rotation, away from a lot of the stocks that got us to where we're at, and rotating into some of the other areas that have been less successful up until this point, especially on a relative basis. But days like today, you see a continued follow through with communication services, with technology, the number one and two. Follow that with materials, and this is the gold stocks and as well as many others within the material space doing better. On the bottom, you have sort of the laggard ship that we've seen up until now: financials, energy, real estate, and so forth. So it's sort of more of the same, but not enough to propel the S&P higher. And I think that may be telling. We'll see. A lot of great content coming up on StockCharts TV. Earlier today, just this afternoon, we recorded our latest episode of The Pitch, and that's actually running right after this show at 6:30 p.m. Eastern today on Thursday the 13th. Had a fantastic conversation with Dave Landry, Tom Boley, and Grayson Rose. They each brought 5 stocks with them, had a chance to pitch their ideas, and then we discussed them as a group. And it was a fascinating discussion. Just a great window into some of the thinking of some top strategists. Next week, starting on Monday, we have our next episode of Behind the Charts. That's featuring an interview with Tony Turner that we did at a Money Show conference a number of months ago. As just a quick heads up, this winds down our first season of Behind the Charts. We've been running episodes of this every week for months and months and months. Had so many great interviews with some top analysts, technical analysts, strategists, money managers. Over time, we're going to take a break and reset and gather some more interviews and come back with you very soon with more episodes of Behind the Charts. More to come there. And then on this show, on Final Bar, next Tuesday, we have Jesse Felder. On Wednesday, Katie Stockton. And then on Thursday, Samantha LeDuc from LeDuc Trading. So some fantastic guests. And Ari Wald coming up with us shortly today. No exception. He's one of my favorite analysts. When I was on the institutional buy side, following outside experts, Ari was one visit we always certainly look forward to. So it'd be great to get his take here shortly. Let's get to our market recap. As I mentioned in the introduction, we have this interesting perspective of looking for leadership rotation. I remember a couple weeks ago, when we were getting ready for our charting the second half mid-year specials, I sat down with Ralph Akampour and was talking to him in particular about leadership rotation. And his comment was, over the coming weeks, coming months, you'd really want to see a rotation away from some of the sectors that had gotten us here, and you look for emerging leadership. Places like industrials make sense. Financials could be, staples. Who knows what it is? But looking for some alternative leadership. On the other hand, when I'm thinking of my conversations this morning or earlier today on the pitch, which you'll hear shortly, it was very much a pro-growth perspective, sort of like a keep the foot on the gas pedal, buyable pullbacks and things like biotechs and semiconductors. And there's plenty of further upside in stocks like Alphabet and many others that we've ridden up until this point. Tesla came up and so forth. So let's look at what happened today. And the reason I bring it up is the S&P really unable to close above 3,400. It's not been able to get to a new intraday high from that peak in February, but the leadership sort of consistent today with communication services, technology, consumer discretionary, 1, 2, 3 on the list. The S&P finished down just 0.2%, so not too much down, around 33.73. Nasdaq 100 finishing in the positive, and the VIX right around just above 22. Mid caps and small caps actually down a little further. The small cap index sort of led the way further down. One of our 3 and 3 charts yesterday was small caps versus large caps, how that ratio has gone back to favoring small caps over the last 3 to 4 weeks. But today, a bit of a breather from that move. A lot of movements in bonds and in metals. We're going to look at each of those very quickly here, but the TLT finishing down again, down 1%. The dollar essentially flat for the day, so yields higher today. And then gold and silver rebounding after a pretty steep sell-off. Last couple of days have been pretty brutal, with silver especially finishing more at the lows of the day, but rebounding back to the upside with the SLV, one of the liquid silver ETFs, up almost 9%. Let's start with some of those charts of gold and silver. So this is the GLD, which we've talked about. And, when I'm thinking of gold, the long-term trend is positive. That's why I'm starting with the 2-year chart. Just a reminder that gold has this tendency to become extremely overbought, sort of a breakout of an established base, to sort of chop around a little bit, sort of digest those gains. I always call that a digestion move when you have a big rally and then sort of a sideways pullback. If you look, 38.2% was about the right pullback here in mid-late 2019. Same thing, almost identical here in early 2019. And in 2020, you saw kind of a similar pattern too, right? You broke bearish divergence here, an extreme overbought condition. We rallied a little bit further, but then pulled back to support before breaking out. Potentially we're in that same sort of environment. I just think the long-term trend in gold remains very positive. I think with silver, it's the same thing. So I see a lot of further upside from here. The challenge that we saw with these metals is that they went vertical. So here's the GLD, which is now pulled back just about 38.2% of the way back. If you start the clock in early June, here's the chart of silver. You can see same thing, that parabolic rise, and now this pullback coming out of the extreme overbought condition. So, I see that sort of pullback as a reasonable pullback within the context of this exponential rise. I think when things start going vertical, you have to expect at some point the music will stop. There's a bit of a right sizing, a pullback to the longer term trend. But I see with both of those that the long term trend certainly appears to be more positive. Where there's a bit of a concern, though, is if you look at bonds, we could look at yields, but I'll start with the TLT, which is the long bond ETF. The last week has certainly been painful with the TLT, with an RSI getting below 40, which is more characteristic of a bear cycle than a bull cycle. All of a sudden, bond prices, instead of looking like they're in this long-term uptrend, now appear to just be in this consolidation, right? Sort of this rally into the peak in March. Clearly a lot of dislocation here in the month of March. This is around, heading into the March equity market lows. And then from there sort of sideways. And now you potentially have, if you look at a closing basis, the closing high was right there, just around 170. We broke above that here in April and we're unable to eclipse it. We closed above that a couple sessions in the last couple weeks. And now I've broken back down to that 170, 172 range is sort of the resistance. That's the level where you're finding that bond prices are unable to break above, and it's sort of the opposite, sort of the inverted pattern that you saw here in the second half of last year. So overall, it makes me feel like there's certainly limited upside for bond prices, and lower prices mean higher yields, rising rates, which would be sort of a different environment than we've potentially seen in a while. Let's get to the chart of the S&P here. And as I mentioned earlier, we've talked about this a number of times. I think we're approaching that key line in the sand of 3,400, trying to close above that for the first time. And when you look at it, for me, I feel like what the path of least resistance, the path that would benefit the most investors, I would say, and that may be the reason why it doesn't happen, would be a pullback to around 3,200 to 3,250. That would put us back in the range of the peak from early June. That would put us in the range of the low from mid-July. If you're bullish, I think you'd have to see that a bit of a pullback down to around 3,200 would be a nice, reasonable pullback within a slow and steady uptrend. You could argue that the reason why the S&P is able to be at 3,400 now is because it had that pause in May and because it had the pause in June. That's what gives the market an opportunity to sort of reset, gives buyers a chance to, to regain interest, or, new buyers coming in, new demand entering into the market, pushing the price to higher highs. If you don't have those pullbacks, you can't just go vertical like that. You need those are necessary pauses. And I think the fact that we're at the overbought range, the fact that we're at resistance, that's sort of what I'm expecting. That's my base case. Now, that doesn't have to happen. I think if it starts getting above 3,400, I think you will get people chasing that very quickly, and all of a sudden feeling like they're going to miss out on the next thing. So we're right at a really key point here. And I think with a lot of groups like semiconductors, with big tech, with communication services, I think you're at the point where either you have a more of a pullback, more of a consolidation, or we blow things out and start getting really aggressive on the upside. Looking at some other themes, just to wrap it up, the automobiles group back up to the top. Tesla over the last couple of days has really renewed its upside push after chopping around and giving away some of the previous gains. So Tesla up pretty significantly, and that's driving that group higher. I mentioned gold stocks and the chart of the GLD. So gold miners and mining, both within the materials sector and the top 10 groups. Computer hardware, this is Apple's group as well as others. And then footwear, interesting to see in the top 10. That's Nike and some other places as well, appearing in the top 10. That's our market recap for today. I wanted to take a quick commercial break. We'll be back with my guest, Ari Wald. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. We're going to do another mailbag segment tomorrow on Friday's show. So as a reminder, 2 ways to get a question to us. Number one, shoot us an email, thefinalbar@StockCharts.com, or on Twitter, just tag us in any comment @FinalBarSCTV. Anywhere you see our content on YouTube, elsewhere, just put a comment below the video and we'll make sure we capture those as well. But we'll love to answer your question on the air in our mailbag segment tomorrow. I want to welcome on my guest back to the show, Ari Wald from Oppenheimer. Ari, as I mentioned earlier, is someone whose work I enjoyed following a great deal when I was working on the institutional buy side, and it's a pleasure to keep in contact, Ari, with you going forward. But thanks for coming back on the show.
Hey, always a pleasure, Dave. Thank you very much for having me back on the show. Appreciate it.
Of course. So, as I mentioned, we're thinking of the market, S&P testing this key 3,400 level. The question is, do we continue to see this pro-growth story as trends persist, or do we pause in some meaningful way? Chart number one is just is thinking about sectors. I'd love for you to take it from here.
Sure thing. And our view would be, aside from a pause to refresh, I think it's really just a matter of time before the S&P breaks higher. And while concentrated market returns remains this lingering concern, the takeaway coming from our work is that internals are basing rather than topping, and consistent with where they should be just 5 months after a major market bottom. So while we don't see a bubble in the overall market, we do see a bubble emerging in sector dispersion, and that brings me to my chart. It plots the rolling spread between the best and worst performing S&P sector over the last 2 years. So the current reading is above 100%, which is picking up tech's 50% gain minus energy's 50% drop. Now, this is the widest reading since the CMT bubble, but what's driving it is what's surprising. If you were to dig into this, Dave, the bubble's actually being inflated by weakness in value sectors rather than strength and growth.
Yeah, that's really interesting. This is a look I bet a lot of our viewers are not familiar with. So you're basically looking at the top performing sector versus the weakest sector, the lowest performing sector, looking at the spread between the two. And your point is, it's not just the aggressive leadership from the pro-growth sectors we've talked about. It's the laggardship on the downside, right? It's the sectors that are struggling behind the curve almost, right?
It shows you how important sector selection has been over the last 2 years, getting into the right ballpark. And I think while many would often attribute it to the strength in tech and pro-growth, I think what's more extreme is actually what's happening on the other side of the equation. And that brings me to my second chart. So it argues for this idea, showing the 2-year rate of change for technology and financials, which are the dominant sectors in the growth and value benchmarks. So the top panel shows the 50% gain in technology over the last 2 years. And you can see this reading is really far from the extremes of the late 90s, which is why we continue to stress that the steadiness of tech's advance is an underappreciated point. Now, the bottom panel shows that it's the weakness in financials, which is coming off its lowest reading since 2009 and can be considered the more extreme reading. So for us, it's don't blame tech's rally for the bifurcated returns. Blame financials and the rest of the market because they haven't been able to keep pace. And really to us, this just exemplifies the difficult market backdrop we've endured over the last 2 years and why we think the contrarian case is for long-term market upside. If this dispersion deflates to more average levels, we think it's going to come on a broader market advance with deep value cyclicals acting better. So this is something we're rooting for, though tech still makes a lot of sense for us because it's also tended to be early cycle through market history, semiconductors most notably.
And there's no doubt, obviously, the relative strength in technology has been pretty consistent, right? Even through the the up and the down segments of the market for the last 12 months plus, I would say. I'd love to. We just have a minute left, Ari, but I'd love to just ask you a question just about the broader market environment. So as you mentioned, I think a healthy pullback, but certainly expecting further upside, which that is a well-grounded technical theory, and I 100% it makes sense to me. I'm curious what you would see that would tell you that's not playing out as you'd expect. Is it, would it be a pullback that breaks a certain level? Would it be a change in leadership that tells you some of those some of the sectors that have been leadership, sort of the TMT names are rolling over? Or is it some other indicator, a weakness in breadth perhaps, because the breadth, as you mentioned, has been positive to neutral, but it's not gotten anywhere negative? Give us an idea of what you would look for that would tell you things are starting to get a little more painful than I would have expected.
Yeah, for us, it comes down to the breadth data that you mentioned, that we're saying that breadth is basing, and one by one, these areas are going to turn up, break out to the upside. But we always say, if we're wrong, it's the weak that get weaker. It's not about lofty market valuations when the cheapest stocks are the ones getting hardest hit on the market crashes. That's what we saw in the first quarter. On that big market drop, it was the cheapest stocks, financials, that got whacked by the hardest degree. So once again, it's this idea that, yes, we hope financials are basing. If they start to roll over, that's what's going to give us concern, that we're not quite there yet. And I think, again, why tech is a more attractive bet here. There's more support on the downside.
That's a great take. And Ari, if there's one thing I took away from this conversation, it's a reminder. I think there's such a focus on technology and the leadership groups. You've reminded me to focus a little more on what hasn't been working and see what sort of signal we can get there. Ari Wald from Oppenheimer, pleasure to have you back as always. Hope you and the family stay safe and keep in touch, all right?
Pleasure, Dave. Talk soon. Bye.
This is Ari Wald from Oppenheimer, and again, I think you can see why I always enjoyed, getting a visit from Ari when I was up in Boston. He always brings just some great thematic stories, making you think and wanting to dig deeper into some of those themes. I love that chart, looking at the dispersion between some of those key sectors, the top and bottom sectors, and reflecting on not just the leadership but the laggardship in the market and what we can draw from that. Our next segment is called Today's Chart List. This is one we haven't done in a little while, but the chart list system on StockCharts is something that I've really enjoyed learning more about. And some of the power users of StockCharts.com, guys like Greg Schnell and Grayson Rose and Tom Boley and many others have shown me the benefits of the way that the platform is set up using chart lists, because it allows you to bring in a lot of different looks and organize them in some pretty powerful ways. What I wanted to do today is just give you an example, one of those that I use, and just give you some food for thought. One of the things that is worth paying attention to when you look at sectors, it's very easy to get caught with their blinders on and just focus on particular sector ETFs. So I often, when I look at sectors, I look at this list. This is my list of sector ETFs. It's the XLK for technology, the XLY for consumer discretionary. I'm sure you're familiar with all of these. These are the classic, sector spiders. And they are, of course, cap weighted, meaning a stock like Amazon is a huge weight in something like the XLY because it's a much larger market cap than most stocks in that particular sector. So you have an issue in the XLY, not an issue, but something you should be aware of, that if you buy the XLY, I think 25% of that bet is Amazon, and probably another 13 to 15% is Home Depot, and after that, it's sort of everything else. So you have a huge weight in basically two stocks, and that's okay if you're aware of that. The problem I find is when people buy an ETF and they don't realize the bet that they're making, sort of an unintended consequence, perhaps, of that bet. This here is a chart list that I use, which takes each sector. So for example, you have the XLC, which is the Communication Services ETF, and then I'm showing the EWCO, which is the equal weighted Communication Services ETF. For XLY, which is consumer discretionary, you have the RCD, which is an equal weighted consumer discretionary ETF. I'm starting at the top with just equal weighted S&P versus the regular cap weighted S&P, and we'll start there. So here's what the chart looks like. I'm basically looking at a ratio of the RSP to the SPY. So it's the equal weighted version versus the cap weighted version. If this line is going down, that means the equal weighted version is underperforming the cap weighted. If it's sideways, they are equal. And if it's going up, that means the equal weighted is outperforming the cap weighted version. What does that actually mean for you? And here you can see them individually, although to be honest, they tend to move in a very similar way. The ratio is what tells you the relative performance of one versus the other. Here's why it's key. If the line's going down, that tells you the equal weighted version is underperforming, meaning the larger names, the big mega cap members of that sector are what are really driving the performance. They're doing better. If it's sideways, that means that there's no real gain from buying the larger companies versus the smaller companies. You're getting a similar return across the board. If it goes up, that means the smaller companies within the benchmark are outperforming the larger companies because the equal weighted, again, is outperforming the cap weighted. Meaning when you take that overweight of Amazon or Facebook or any of those huge names, Apple, all of a sudden the equal weighted version, the average participant, is outperforming those mega caps. So it's essentially a look at the other, all the other stocks in the sector versus those big mega cap names that you probably know. So looking at this, what you can see is over the last 4 to 5 months, there essentially has been, it's been flat. If you look at the equal weighted S&P versus the cap weighted S&P, meaning you really haven't, even though we think of it as a mega cap led market, it's what it's felt like. I think Ari's comment about breadth being, pretty constructive and now sort of basing right now is the fact that it's sort of even, right? There's no big advantage of owning the huge companies versus sort of the average company if you look over that longer period of time. Let's look at each one of these though individually. We'll start to see what signals we can find. I'm going to view all of them. So that was the random one. That was the broad market. Now we're looking at communication services equal weighted versus cap weighted. So when this line is going down, it's not just going into the market low that the largest companies were outperforming. It's actually been a trend going back through last fall, the middle of last year. You can see this line going lower, meaning the equal weighted, the average stock in there is underperforming the largest companies. And it, again, relatively sideways, but you can see how it's just breaking to new swing highs here. What's interesting here is you can see how the equal weighted version is still making a huge base over this live period. It has not eclipsed its February highs, whereas the XLC has already broken above its previous highs, showing you the strength in the mega cap communication services names. This is a ratio we've looked at pretty often, which is equal weighted consumer discretionary stocks. We look at this relative to consumer staples. You can see the same thing. Cap weighted has broken well above its previous highs. The equal weighted nowhere near its previous highs. You can see that even though the relative strength essentially flat, you can see it's certainly the mega cap consumer discretionary stocks that have broken higher. Here's what actually gets interesting. Within staples, the ratio has actually been going lower, meaning the cap weighted, the largest stocks within consumer staples have absolutely been driving it higher. Look at energy, where you see since the March low, it's been a pretty consistent uptrend, meaning you're better off owning the smaller names within energy. Again, all else being equal, they've outperformed the largest stocks in there. Within financials, it's rolled over from mid-March to mid-June. There was certainly a move towards some of the smaller stocks. And this is when things like regional banks are doing better than the largest banks that are out there. Since then, it's been sort of sideways. So the reason why I'm showing you this is I find a lot of investors treat this sector as very simplistically. They think about consumer discretionary or industrials or financials, and you think of it as a bet into the XLF, and that's kind of it. What you have to remember is underneath the hood, there's a lot of color you can get by looking at things like equal weighted versus cap weighted, by looking at breadth measures on a sector, looking at bullish percent indexes, looking at scooter rankings for the different groups, and see the configuration of those. So if you've not looked at these before, this is a type of chart list that can be helpful. And it's not something I look at all the time. It's something I look at, when we get to a point like we are now and the market's testing highs. And my question is, how sustainable is this within different sectors? Where am I seeing potential opportunities? This can be an interesting chart list to reflect on the largest versus smallest stocks within some of those different sectors. So that was today's chart list, looking at equal weighted versus cap weighted ETFs. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. We're going to start with a chart of the SLV. I mentioned we did recorded the pitch a couple hours ago, and we're going to be broadcasting that immediately after the show. And one of the 15 tickers that was thrown around as a potential long idea was the SLV. I'd encourage you to watch it to get the full details of what was said and why. But as we talked about earlier, I think the precious metals charts have gone vertical, and that's absolutely right. What's interesting is they went vertical in early July. They have remained in an accelerated frame of a pattern. So I would caution you when you see something jump out like that. A lot of people get very nervous, thinking, "Oh, it's overbought. Oh no, I need to worry. I need to stay away from it." Remember, there are plenty of examples through market history where something goes vertical. It doesn't just stop. It continues to go. And it was often said, don't confuse the top of the page with resistance. Things can go much higher than you'd expect. Things can go much lower than you'd expect, of course, as well. So with silver and with gold as well, I think you've seen a steep pullback very quickly after a steep rise. I think overall, the pattern of higher highs and higher lows has continued. I think there's still further upside with those charts until we start breaking down through support levels. Now we've established a pretty good higher low right around $23 on the SLV, and on any further pullback, that's certainly where I would look. But overall, I think the relative strength continues to favor gold and silver. Chart number 2, we talked about the potential weakness in bond prices, higher yields, and just as a potential next step. I've been thinking about bond prices and watching this uptrend for a while and talking about it. What strikes me though now as prices coming down, the TLT coming down, is you can see this pretty good resistance range right around 170 to 172. I'm going to add that on the chart here after the show to remind myself to focus on that. You're seeing this sort of parallel universe from the lows that you saw here in the second half of 2019 before the rally, and sort of this peak that you're now establishing, a clear resistance level that's now a triple top of sorts. We're not really able to get above there, and it sort of suggests to me that there's limited upside in bond prices until we're able to eclipse that. Chart number 3 is biotechs. Another theme that came out of our discussion on the pitch was biotechnology. We had a lot of particular names we were looking at, but for me, the IBB is a fascinating chart. I think one of two things happen. I think this might be a preview of what the S&P chart could look like in a couple of weeks, which is a test or a break to new highs. It's obviously a little more extended than the S&P, but then a decent pullback. This didn't even get to 38.2% of the way. It's down just above 132.50. I could see it still drift even a little further down to those June lows. But overall, I think we're entering that point where if you feel like biotechs are going to work, you're right at the point where you could start to think about nibbling a bit, only because the RSI is down to around 40, which is usually a decent pullback within a longer term uptrend. The relative strength has been lower, which has indicated the rotation away from those in favor of other places. But again, if the long-term trend is going to work, one of the best long-term patterns you can find is a long-term uptrend, a short-term downtrend, pulling back to some position of weakness. So it might be a preview of what we see on a chart of the S&P 500. Folks, that's our show for today. I want to thank Ari Wald from Oppenheimer for coming back on the show today. Great take on sector leadership and laggership. As a reminder, we're going to do another mailbag segment tomorrow, so get your questions to us. The final bar at StockCharts.com. Just shoot us an email. We'd love to answer your question on the air. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.